Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, July 31st, 2021. And our top story this week, lifetime income disclosures are coming for 401k and 401k-like plans next year. Well, joining me now to discuss this and a lot more, Austin Ramsey of Bloomberg Law. Austin, great to see you again. Thanks so much for joining us on the program this morning.
Thanks for the opportunity. Look forward to it.
Yeah, it's always great to catch up on new regulation, get your perspective. One such rule that is going into place, I think, next year is lifetime income illustrations for 401k and 401k-like programs. What's your take?
Well, this really dates back to a change that we've been seeing in the retirement industry that dates back 20 years. We've slowly seen this shift from the traditional defined benefit pension style plan to the 401k. And one of the biggest problems or consequences, if you will, of that has been that retirement participants have lost a lifetime income stream. The onus, the responsibility of maintaining an individual retirement account has shifted from the employer to the participant. And we've seen that retirement security, broadly speaking across the nation, has been kind of turning in the wrong direction. That's because a lot of participants are not taking that careful look at their retirement income, taking a careful look at their account balance, and trying to figure out what that will look like or turn into as a lifetime income stream in retirement. And so the Secure Act in 2019, this was one of the first chances, one of the first opportunities that lawmakers took to try to address this problem. And the way that they did that was they decided that they want to give participants a chance to see what their account balance would look like, their present day account balance, what it would look like as a lifetime income stream in the form of an annuity. That's either a single annuity or a joint or survivor's benefit annuity at 100%. And so Secure Act 1.0, if you will, of 2019, that comes out, that requires the DOL, the Department of Labor, to issue a rule. And that rule has to put in place the assumptions that will be required for forming these quasi annuities, and also put together model language, what this would look like in the either annual or quarterly benefit statements that your viewers and retirement participants, broadly speaking across the nation, see regularly. And so the DOL issued that rule on August 18th of 2020. And it was in the form of an interim final rule, which essentially means that it takes immediate effect, but it's not final. So we're still waiting on a final rule from the DOL. But in the meantime, we know that retirement plan administrators are going to have to start providing this information starting September 18th of this year. They have 1 year to provide that starting on that date. And so, there's a lot of uncertainty in the industry right now about what specifically they have to provide, when they have to provide it, and what this is finally going to look like when a final rule comes down.
Yeah, and this is really good, important information, as you said. I mean, now that you have responsibility as an individual for managing your retirement, thinking about how long you're going to live. We don't know, we really all don't know that decision point, but there's longevity. So having this information is important. Austin, this kind of takes me back to the fee disclosure regulations from, 2008, 2009, that I think became effective and basically required a similar disclosure for what you're paying in terms of your retirement plan.
That's right. Yeah. I mean, I think many of your viewers now and retirement participants are kind of used to seeing that now. You see your account balance, and then you flip a few pages and you start seeing a list of all of the different investments that are on the plan investment lineup, and you see what they're charging you to invest in these kinds of fees. And you're right. This is really important information. Why? Because, like I said, from the beginning of this, we have seen this shift from plan participants getting a monthly check, no matter what age they are, no matter, what the circumstances are. They get a monthly check from their employer because they put their service in. These days, you have a total chunk of change, and you are responsible for turning that total chunk of change into something that can last through your retirement. And there are so many uncertainties. The assumptions that the DOL put in place in their interim final rule assume that you are age 67 on the date that the particular lifetime income illustration comes out. It assumes you're 67. It assumes you're married, and it assumes that you've set up an annuity at 100%, so that once you pass away, your spouse is receiving 100% of that income. There are a lot of things that can change. If you actually roll over your 401k into an annuity, you can choose. Well, for one thing, you may retire at a different age. You may not be married. You may choose a survivor's benefit at 50%. There's also differences in age or in gender. The DOL interim final rule assumes a gender neutral treasury rate. So that essentially means that males typically do not live as long as females, and so typically their annuity payments are slightly larger than females. And so all of these are uncertainties that the DOL is trying to address in their interim final rule by providing something that's simple. And the reason for that simplicity is that if you change jobs, you want to be able to compare the lifetime income illustration that you were receiving from your former employer with the one that you're receiving now. But employers are concerned about this because, there are a number of factors that aren't taken into account. For example, one of the biggest ones is it doesn't take into account future contributions or future earnings. You're turning your present day account balance into an annuity, assuming that you're 67, and that's not really necessarily realistic. It also doesn't take into account the kinds of earnings or lack of earnings that you might receive in most annuities. Annuities are complicated products, and there's a real concern in the industry right now that this is going to stifle innovation.
Yeah, it's going to be interesting to see the response from the record keepers, or those are the administrators that you're talking about that actually do the production of statements and these illustrations. There'll probably be a lot of questions. And then I guess we're going to have to see how participants, people like you and I, actually respond. Are we going to do anything differently from getting these sheets of paper, or digitally, of course? I don't think it'll be a sheet of paper, but getting something digitally. Austin, we're going to have to leave it there. Really appreciate you popping on the program. Great to see you as always. Great insight, great analysis, and we look forward to having you back again very soon.
Sounds great. Thanks, Jeffrey.
Thanks, Austin. Great to see you. Thanks for sharing your perspective. And when we come back, we'll take a look at some of our best segments of the week. You're going to want to stay tuned right here on BRN Weekly.
You need a financial plan that fits the way you want to live in retirement. A plan that can help grow and protect your money, now or in the future. With an annuity in your plan to help cover essential expenses, you'll have the freedom to live the retirement you want. This is what an annuity can do. Find the right financial professional to show you how. Learn more at protectedincome.org.
Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. On Wednesday, I sat down with the Alliance for Lifetime Income's Tom Hegna to learn about the basics of annuities and the different types that exist. Let's take a look.
You know, annuities can be confusing to some people, but an annuity is simply a contract between you and an insurance company. And there's really just two basic types of annuities. There's immediate annuities, some people call them income annuities, and deferred annuities. Now, immediate or income annuities, they have one job, and that's to provide income. They can provide it for a period of time, or they can provide it for your lifetime or for multiple lifetimes if you're married or if you want to do it grandparent, grandchild. But it guarantees you a paycheck as long as you're alive. Now, most income annuities traditionally were called single premium immediate annuities, and they started within 12 months. Now there's a whole nother set of annuities called deferred income annuities, and that's a single premium immediate annuity that you and I can buy, and we can buy it today, and it doesn't have to start for up to 40 or even 50 years. And so the longer you wait to start the income, the higher that guaranteed payout rate. Now, in the deferred annuity space, there's basically three types. There's variable annuities, there's fixed indexed annuities, and then there's just basic fixed annuities. A fixed annuity just earns an interest rate. It's very similar to a CD that you buy at a bank, but it's not FDIC insured. But every day it's worth more than it was the day before. It earns a fixed rate of return. A variable annuity on the other side is in the market. It's in a set of mutual funds. They're called separate accounts inside of a variable annuity. But those things can go up 30, 40, 50%, but they can also go down 30, 40, 50%. But while they're growing, they grow tax deferred. And in between the fixed and the variable is something called a fixed indexed annuity. And that is one where you get some amount of upside with the market, but you're guaranteed never to lose. And so really, I think it's so important to work with a financial professional because they can assess what is best for you and make a recommendation that would best fit your needs. You know, 10 years ago, you couldn't buy one of those deferred income annuities. They didn't really exist. I mean, one or two companies might have had them, but they weren't broad-based. You know, in the fixed indexed annuity world, there's all different kinds of indexes. Now, some have uncapped strategies, so there's not a cap of like 4% or 5%. Some are uncapped. And of course, the index itself is more of a diversified index, but that was never available before. In the variable annuity space, there's some new variable annuities called registered index-linked annuities, RILAs, and those don't have fees. So the big knock on variable annuities is that the fees are too high. Well, they came out with these registered index-linked annuities that can be no-fee products. They're also guaranteed income benefit riders, guaranteed withdrawal benefit riders, guaranteed cash value riders that weren't available maybe 10 years ago as well. A variable annuity has many different funds available. And among all the different companies that are out there, there are literally thousands of sub-accounts. And I mean, everything from, you know, small cap stocks, mid cap stocks, large cap stocks, value stocks, growth stocks, emerging market funds, natural resource funds. There's bonds, there's short-term bonds, long-term bonds, government bonds, high yield bonds. Almost anything you can get in the mutual fund world, you can find in a variable annuity. But here's what a lot of people don't know. Last year, there were hundreds of variable annuity sub-accounts that were up over 20 and 30% after fees. And see, I don't sell annuities. I don't get compensated on the sale of any annuities, but I own 11 of them. And if these were bad products, if these were stupid products, I wouldn't own any of them. And I don't think I'm any different than many of your listeners. You know what I want to do with my money? I want to make as much as I can make. If I can make 10%, 20%, 30%, I want to make as much as I can make. But just as important, no, for me, more important, I don't want to lose what I've already got. Well, mutual funds and ETFs can't do that for me, okay? But a variable annuity with one of those income benefit guarantees or cash value guarantees or withdrawal benefit guarantees that, I'll get participation in the upside of the market, but if the market crashes, I'm not going to lose all my money. I've got either an income guarantee or a withdrawal guarantee or a cash value guarantee. And those guarantees matter to me as somebody who is entering retirement myself. Tax deferral is one of the biggest benefits of deferred annuities, that as the money's growing, you don't pay any taxes. So imagine if last year you were in one of those sub accounts and it did 30%, and then you sold out of that and you bought another one, and over time it did another 30%. And you just kept doing that over a 30 or 40 year period. Not having to pay taxes on all that growth is a significant advantage. Another thing is people don't realize you can get tax-free income from annuities. I've converted most of my IRAs and 401ks to Roth IRAs, and I put them into income annuities, and now I'm guaranteed to have tax-free income for the rest of my life. Understand that I paid my taxes when I did the conversion, so it's not like there's no taxes, but I believe these are the lowest tax rates I'm likely to see for the rest of my life. So I paid those taxes. Now I'm going to get tax-free income for the rest of my life, and I think that's going to be very important. So let's take them both separate. The deferred annuity. So a deferred annuity is growing. And while it's growing, it grows tax deferred. If you die, that money would go, 100% of it would go to your named beneficiaries. Okay. Now on an income annuity, if you're getting a paycheck for the rest of your life, you need to pick up front what type of death benefit option. Do you want it to pay for you and your spouse as long as either one of you is alive? You could do with you and your granddaughter and pay as long as either one of you is alive. Or do you want to get a paycheck, but when you die, you want the money that hasn't been paid to you to go to your family in a lump sum? There's many different death benefit options, and you get to pick that up front. But even in the case where people think the insurance company keeps the money, that's not true. If you do pick life only, that's the highest payout rate on an income annuity, and you die, the insurance company doesn't keep the money. It goes to the other people that pick life only that live. That's why the payout rate is so much higher. So there's a lot of misunderstandings around that too.
And on Friday, I sat down with MillionAcres.com's editor, Deidre Woolard, to talk about affordable housing on the decline. Let's take a look.
I think there's a lot to be worried about. We've had 112 months in a row of price gains. Median price of existing homes, according to NAR, was $363,000 in June. That's just incredible. That's over a 23% increase from a year ago. So we've got a lot of factors going on. The lower interest rates are making the affordability crisis not quite as acute. Inventory is still really low. It's below a 3-month supply, and houses are selling so fast that it really puts a lot of pressure on home buyers. And so the response for this is that we're seeing this massive increase in single family rentals, and the desire for them is really impacting the market as well. Well, and it's really created a situation where even if you are a seller and it's a great time to sell and you can make money on your house, where do you go? So that's part of the reason that people are just staying in their homes, and we're not seeing that inventory shift. We're seeing a little bit of hope. Inventory is increasing slightly, but not to the level that it needs to based on demand. And it's really putting so much pressure on buyers. And some of them are getting so stressed out. They're losing multiple offers. They're offering everything they can, waiving contingencies. And they get to the point where they just can't do it anymore. They get too emotionally worn out and too financially worn out. Well, I think you've got some pretty cautious people between Powell and Yellen when it comes to thinking about interest rates. I don't think that they're going to rise precipitously. I think that, and right now we're starting to see a little bit more uncertainty with this Delta variant, which is also giving everyone a little bit of a pause, thinking about what a second lockdown could mean. So all of that is making things a little more uncertain than they were even 2 months ago. It still is likely that we're going to see some interest rate rising, but I still believe it's going to be very slow. Absolutely. I mean, luckily the prices of lumber have calmed down from that like stratospheric high that we saw in the spring, but we're still seeing massive supply problems. Price of steel is also very high. But the commodities issue and the supply chain problems really haven't gone away. It's been over a year that we've been having these problems. You probably see it all over the place in stores with, certain grocery items, but it's also impacting the building of new homes. Some home builders are having to slow down simply because they can't get all of the supplies they need. I mentioned that single family rentals, there's a bias towards those right now, partly a post-pandemic effect of people wanting not to live in large buildings where there's shared amenities and things like that. So you've got this desire for single family, but you've also got a shortage in supply. And so in terms of building affordable housing, there's a lot of talk about modular construction, how to build faster, how to get away from stick built. It's been a debate for since, probably decades, but it really does need to happen. I feel like technology is getting to the point where we might be getting closer to that. So that's one thing to look for. The other thing is the impact of remote work. And what we're seeing is younger people who are looking for housing are just going further and further away from cities where things might be a little more expensive. And so that is another option as well, although who knows what happens with remote work. So that is a question mark.
Well, those were certainly great segments. I want to thank all of our great contributors this week. And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement, markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow, this time for BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the news for the week. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and seize your bank accounts. But you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.